I truly believe that the nature of capital markets, the nature of investment, and the nature of what a business is designed to do have been fundamentally changed by the perversion of incentives, which naturally follows the perversion of money. This to me is perhaps the existential crisis um, facing investors, particularly in markets today.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I'm very excited to be welcoming today's guest, as a very special guest in my business of interviewing top minds in markets and the money. I think here at Thoughtful Money, we do a pretty decent job of that. But in my mind, there's nobody better than Grant Williams, publisher of Things That Make You Go, hmm? And one of the best macro analysts in the business, as well as, I think, the gentleman who sets the gold standard for financial media interviews. We're joined by him today. We're going to pick his brain in terms of what he sees going on in the current macro environment. There's been a lot of big changes I want to ask him about. He's also just hosted a conference of his own with the wonderful Stephanie Pomboy, and I want to get a sense for what were some of the key outcomes from that great event as well. Grant, thanks so much for joining us today.
Adam, thank you. And thank you for having me. And thank you for that overly generous introduction. You're very kind. Thank you.
Oh, hey, it's just the truth, my friend. Well, look, Grant, like I said, a lot of big changes have gone on. Obviously, we have a new president-elect as part of that. Want to dig into all that with you. But if we can, just to set the stage, I'd like to ask you the question I like to ask everybody at the beginning of these discussions. What's your current assessment of the global economy and financial markets?
Yeah. Well, I'm not sure what we're going to have room for at the end of this then. It's funny. I've had a couple of conversations this week with good friends of mine. And, my takeaway from those conversations, which I'm still kind of formulating, is that there's an awful lot of problems out there facing President-elect Trump, and by extension the rest of the world. There are plenty of signs of hope in terms of things he could perhaps do to try and change things. There's hope in terms of the fact that it feels like there's an understanding of how serious the problems are. But the takeaway I keep coming back to talk with people, and we'll get into why perhaps, is just how difficult it's going to be to thread this needle
Mhm.
because um, you know the Trump 2.0 presidency is happening at probably the best and the worst time, because he's a president who is going to shake things up, and things need shaking up. Um, but it's happening at a time when the amount of disruption around the world is escalating. You and I are both proponents of Neil Howe's fourth turning thesis, and so to have a disruptor in a time of disruption um, is good and bad. And I think we're all going to have to be ready for the good and ready for the bad, as we kind of move through the next 4 years. So, uh, this pro-growth program of which Trump is undoubtedly going to unleash lower taxes, massive cuts to regulation, massive cuts to big government. Let's assume that he gets all of those through, and let's assume that he does pursue those policies. Um, there's many a slip twixt cup and lip, as the saying goes. It's not a given that he's going to be able to get all these things done, but let's assume he goes that way. The cutting of regulation is going to be important, particularly in maybe the oil and gas sector. The cutting of taxes is going to be important to stimulate growth. The cutting of waste from the government is also going to be an important way to get a handle on the US's dire, and it is dire fiscal position. But every single one of those issues potentially has poor ramifications. So if you think about the tax cuts, reducing government receipts at a time when they need all the income they can get. If they don't feed through to if lower tax rates don't feed through to higher receipts and more growth, that's a problem. Um, Cutting the government, reducing the size physically of the government is going to obviously um, impair employment numbers in the US. We don't know to what degree, but it's certainly going to have an effect on those at a time when higher unemployment is going to be an issue. Um, and so, cutting regulation again, it's optically and at headline value are a good thing, and I think very necessary in the United States. But it's going to create an awful lot of pushback, an awful lot of people that don't want to see regulation cut, and cutting regulation can have very good consequences and very bad consequences, and we've yet to see which ones they are. So each one of these, to me, feeds back into the place that I've been focused on since 2021, 2022 now, and that's inflation. Inflation to me is the real problem here. That's the thing that is finally sitting here over their shoulders, holding their feet to the fire, and is going to kind of keep them honest. Um, and you know, everything that Trump is going to try and do, if we add in tariffs, uh, which is going to be a big thing, they all feed back into inflation, as does reshoring, which is another big thing that Trump is a proponent of. Higher prices from these levels is going to cause significant unrest among people, I think. Um, and if we see bond yields go much higher, again, with the US funding requirements, that's also going to cause a huge problem. So, while there is hope in what Trump is setting out to do, if he's successful, it may create a whole new set of problems. So, as I look across the world and I look at the BRICS, we've seen the BRICS summit. I was talking to Simon Hunt this morning about this very thing, and you know, there's a lot of kind of cold water poured on the BRICS whenever there's a BRICS summit because people expect something very definitive to come out of it, and every time it doesn't, um, everybody who's a kind of proponent of the BRICS says, "Well, that's going to happen next time." And everyone who's a detractor from the BRICS says, "Well, this is never going to happen." Um, and these absolutes are a problem because the direction of travel here is perfectly clear, both in intent and progress. The BRICS nations have a clear goal, which is closer alignment and which is an alternative system to the US dollar payment system. The time it takes them to get there is unknown. So ahead of the Kazan summit, people say, well, this is the time they're going to announce the unit, and this is the time they're going to announce this gold-backed settlement currency between themselves. And it didn't happen. Nobody in the BRICS had said, here's what we're going to do this time. But, the summit comes and goes, and people assume nothing's happened, but stuff is happening all the time. So we all have to get used to a world that we haven't been familiar with for the best part of half a century. And that is a world where inflation is the problem, the constant problem that's sitting here until it gets extinguished, and a world where a very clear global hegemon that has no real challenges um, is no longer in that position, and at a time in its history where its fiscal situation has arguably never been more problematic. That's the backdrop against which we have to measure and estimate everything that we think is going to happen. And because of the nuances of all that, and because of the various moving parts, there's no clear path forward. There's no if X happens, it's good. If Y happens, it's bad. It just doesn't work that way anymore. Throw in the Ukraine-Russia conflict, which is obviously escalating by the day, it seems, with the decision to allow US and UK missiles to be fired into Russia. Throw in the continued unrest in the Middle East. Um, and whichever way you look, you have any number of scenarios that could cause issues and could cause volatility to increase and could cause um, growth to stall, could cause societal unrest, all these problems. If you take all that and you look at a US equity market priced at all-time highs, which is, again, optically looks tremendous, but if you dig below the handful of stocks that have been doing the heavy lifting, you'll see problems. We saw Target results come out today and the stock fall 20%. And if Target's missing, that says something about the consumer that needs to be taken into account. Um, if we see US stocks start to falter, the US stock market has sucked in so much capital over the last, well, what, 5 to 10 years. Um, that capital will be repatriated. And I spoke to Julian Brigden about this week, and he made a tremendous argument for why this is perhaps the biggest thing to be wary of. And as we kicked it around, it's very clear that with the US uh, as let's call it as fully valued as it is, relatively speaking, with the dollar as strong as it has been, everything else has become relatively much cheaper. So if capital does start to leave the United States, if we start to see profits weaken, if we start to see the market wobble, just about everywhere else on the planet looks relatively more attractive now. So that capital, whether it's coming out of the bond market, whether it's coming out of the equity markets, has an enormous number of options in where it's going to go on a relative uh, basis. Um, where does it go into Asia? Does it go into Europe? Does it go into commodities? Does it go into corporates in other parts of the world? Does it go into other corporate bonds? There are plenty of places that capital can go. And again, that just illustrates the kind of fragility underpinning all these markets. So, you know, be cautious about markets here. It's not to say if you're invested, you need to run for the exits, but you do need to look very carefully at the number of things that could go wrong. And we've already seen an awful lot of performance post-Trump that now needs to be justified. So no matter what Trump pulls out of his hat in the first, month or two of his presidency, I mean, he said pregnancy there. If a couple of months of his presidency, a lot of it is priced in. So expectations have been set, and they need to be met. And it's not going to be Trump's choice to meet those. There are an awful lot of factors that are going to push and pull against him in terms of determining the outcome. And I'll stop there and give you a chance to to speak.
Well, that was a great and very comprehensive answer there, Grant. Can't think of anything else to ask you. Thank you so much. It's been wonderful. No, just kidding.
You've been a wonderful audience.
No, wonderful. Lots of things to pull on, lots of threads to pull on from that answer. And I definitely, hear your undercurrent there. There really seems to be a battle going on right now, particularly in the markets of instability, both instability in the global economy, just the geopolitical situation, but also in these very rich valuations that aren't widely supported by when you look across the breadth of the companies that make up our financial markets. And then you measure that by the high degree of complacency, one might say exuberance of today's markets, right? So, folks, I promise I didn't give Grant a heads up of any of these questions in advance. But Grant, you immediately went into territory on a key question that I've been asking other experts who've come on the channel since Trump won the election, and I'd love to get your full thoughts on it. So you talked about it. It's a time of disruption in general. Trump is a disruptor. He was just elected with a mandate for the disruption that he wants to pursue, and he very clearly seems to be, chomping at the bit to start disrupting. Using your words, let's assume for a moment that he is successful, that it's now near the end of the Trump presidency, and he has achieved much of what he hoped to do with the threat of tariffs, with dismantling government bureaucracy, with deporting millions of illegal workers. We haven't even mentioned that yet. My key question is can he be successful with all of those, creating hopefully a better long-term, more economically sustainable future for America, without a lot of near-term pain getting between here and there, right? They say to make an omelet, you got to break some eggs. He's looking to make a massive-sized omelet, if you will, and it seems like he's going to need to break an awful lot of eggs in the process. So I'd love to get your thoughts on whether you think we can or we can't. And if you think we can't, then the question is should one of his top priorities right now start communicating that to the American public, sort of a la times of national sacrifice and pulling together, or World War II, Great Depression, whatever, of like, hey, we're going to get to a better place here, but I inherited a big mess. We have to take some bitter medicine to finally heal the patient here. let's all come together. Let's expect some rough years. Because right now, my belief, you don't have to share it, is that the populace is still riding a high from the election of, oh, it's Trump. He's promised us this big, beautiful economy. They're not necessarily prepared for pain before the sunrise.
Yeah, well, I mean, look, I defer to the great philosopher Yogi Berra. It's hard to make predictions, particularly about the future. And looking that far ahead, looking 4 years, 4 years of Trump is like it's like dog years. It's gonna be like 28 years, and
Right, right,
it's
right,
gonna
right.
feel like. So trying to see the end of that is a bridge too far for me at the moment. I'm still trying to focus on the beginning of it. But look, let's assume he pulls all that off, which is
That's my point. Assume it all comes off. Yeah.
in my view, that's a massive assumption to make, and almost you can't give a 0% chance of anything happening, particularly in these day and age. But it's almost a preposterous thing to think he's managed to pull it off um, without major problems. The thing about the Great Depression and World War II, you're absolutely right in saying they were times when people could galvanize and come together and in a common cause, and Americans have that capacity as a nation. The the problem is, particularly right now, with inequality as marked as it is in the United States and elsewhere across the Western world, um, telling them they need to take that pain beforehand and saying, "Here's what I need you to do for me." I don't think that works. If we're in war, it's one thing. If there is a demonstrable threat, i.e., we're at war with Russia, a full-blown hot war in Europe, or we are in the midst of a second Great Depression, it becomes much easier to say to people, here's what I need to do, because you can point to a set of circumstances and say, look, here's how bad things are. In order to get out of it, here's what we need to do. Saying to people, things might get really bad. I need you to make your lives worse is a much tougher sell. For me personally, I think the place the ball was dropped here was Obama. I think when Obama was voted in 2008, in the midst of the Great Recession, in the midst of the global financial crisis, he also had a very strong mandate when he was elected, and he had a clear and present danger, a threat where everyone's neighbor had lost their jobs, everyone's
Right.
house was halved in value. There was something he could say, look, this is how things are, and things are going to be tough for the next 2 or 3 years, but we need to take solid steps here to right this ship. That was a moment, I think, in history where Americans would have said, all right, I'll take some pain to fix this. Instead, they bailed out the banks. Nobody went to jail, and they fomented this kind of antipathy towards policymakers that has grown and grown and grown
Right. We
um,
we we
in
we
the
papered over
in the
the
16 years since.
losses.
Yeah,
Yeah,
exactly.
and just to be clear, Wall Street paid itself record bonuses in
Yeah,
2000.
all that.
Right.
Yeah, absolutely right. Absolutely right. So that was a real moment in time I felt where a US president, and this is not a Republican Democrat thing, whoever had been voting at that point in time, particularly whichever side had come in with the kind of mandate Obama had and the kind of hope, for change that he had fostered, they had an opportunity to say, okay, I need to make some tough decisions. I've got 4 years and the clock starting on day one of my presidency, so we could have 2 years of pain. There's time for us to get through this rain and maybe see the rainbow at the end of it. And I think people would have initially bought into that. It would have been tougher to keep him with him based on the amount of pain that he would have had to inflict upon them, but he would have had the goodwill to get through. We talk about this euphoria about Trump. I spoke about this a long time before and consistently going into that election that the only positive outcome for America was a landslide victory. Was a
Right.
strong victory, and we got that, which is great because it needed that. Any closely contested election was going to end up in recriminations and accusations on both sides, I think, of stolen elections, and it would have been a nightmare. We've got that strong mandate. We've got a Republican president who won the popular vote, won the Electoral College, has the House, has the Senate, has the White House. Everything is in place for him to do meaningful things. But that euphoria is shared by 52% of Americans. And the problem is the other 48% are not, oh well, next time maybe our guy gets in. A lot of that 48% are staunchly anti-Trump and anti-everything he stands for. And we've seen the division in America right now. And so to pull a country together in a common cause is going to be enormously difficult. And we've had examples of this, and I've talked about this often, but it bears repeating for those that don't remember it. We've seen a similar situation in Japan after Fukushima. The country was struggling post that horrific tragedy. We went into the cold months of that year, 2012, 11. Gosh, it's so long ago. I can't remember now. 11, I think it was. Um, we went into the winter months still without proper power in Japan, and the prime minister went on TV and said, "Okay, we need to pull together, and we're not going to have the power we need, so we all need to eat more soup, and we all need to wear more sweaters." And sales of soup and sweaters went through the roof. I don't think in America today, if you'd said that same thing, you'd get the same response. There would be blame, and it's their fault that we have to, we don't have power, etc., etc. So it's going to be very, very difficult, Adam, to pull America together. The only thing I think that's going to do it, and I think the thing you need, are demonstrable good results from Trump policy. I think Trump can pull people in um, by good results from his policies. And if you look at the reasons everybody voted for Trump, the clearest one across just about every demographic was inflation slash cost of living, was the economy. It's I can't afford this, I can't afford that. I'm struggling to feed my family, I'm struggling to pay my healthcare, my rent, whatever it may be. It's lack of affordability. So if he can bring down inflation, and I mean meaningfully bring it down, not just slow the rate of change, but somehow find a way to make life more affordable for Americans, I think he can pull people across from the other side to get behind him and give him both a stronger mandate and time. But, but the ways he's likely going to have to do that are inherently inflationary. And that's why the big change here, not just in America, but everywhere else in the Western world, happened post COVID, post massive stimulus, when the inflation that had been built up in asset prices post 2008 fed directly through stimulus checks into Main Street and fed directly through into prices. And that's been exacerbated by this, the trade wars and the nascent trade wars, the move to onshore. This inflationary pressure is there, it's pent up, it's coiled, and it could be released by any number of things that Trump does. And if that is released in a meaningful way, what we've seen in the past several months is the shift from people being, I don't want to say willing to believe what they're told about the fight against inflation, but accepting of it. Now they can see, and I've spoken about this idea that to the Fed, the inflationary line is this, right? It goes up and down, and the top band they're trying to keep at 2%, and they're trying to stop it being deflationary. Um, the line that consumers see is this kind of left to right, constantly rising prices because the CPI is an index, and somewhere on that kind of bottom left to top right price index chart, which if anyone goes onto the St. Louis Fed site and looks up the CPI index and not the percentage change year on year or month on month, you will see what inflation looks like. It's just constantly rising prices. Somewhere on that constantly rising line is a horizontal line for every individual family above which things are unaffordable. It's that simple. It's like I can pull my belt in here, I can make adjustments there. We can go to 3 baseball games a year instead of 10. We can eat chicken instead of beef. There are all kinds of adjustments people can make that go alongside this narrative that inflation is coming down. But once you cross that affordability line, once you get to the point where the necessities you need to pay for are unaffordable, you are not listening when the president tells you we're bringing inflation down. You are not listening when the Fed tell you price pressures are easing. You're not listening anymore because no one can tell you something that you can demonstrably see and
Right.
experience isn't true. And
Right.
that's
So
kind of
weathermen
where we are.
telling you that it's a sunny day and you're looking outside seeing the rain, you lose
Well,
faith.
you think,
Yeah.
well, maybe it is sunny over there. Maybe this rainstorm's going to clear and the sun comes my way. Maybe I'm just looking out the wrong window. It's now unavoidable if the government says, "Hey, look, we're winning the battle against inflation," and you are literally selling off the family silver to put food on the table.
Right.
Your trust in government, which has been eroded over the last 10, 12 years, um, gets eroded further and faster because you literally think you are actively being lied to now. So it's there are problems everywhere. There is a path through it, but it's the finest of needles to thread and a really difficult thing to pull off.
Yeah, and it's a great analogy because as I hear you talk, Grant, it does seem that there's a very narrow pathway here between these inflationary landmines, if you will, right, that are there and can potentially get triggered by one of many different catalysts. And then the forces of recession on the other, right? I mean, we talked about the disruption that Trump is likely to bring, which could involve lots of job loss, especially if you're, a government employee. But, we've had the consumer just increasingly tapping out along the past several years, as you just mentioned. They're hitting their maximum threshold there on the purchasing scale. So increasingly, if we continue in that direction, you're going to have more and more households that just tap out and get even cut off by the creditors, right? You get to debt saturation where you can't either afford to take on more debt or they just stop lending to you because you have too much debt, right? And speaking of debt, we have risks like the corporate debt maturity wall, right? The refinancings of a truckload of which are going to happen in 2025. Michael Howell, I don't know if you talked to him recently, but Mr. Liquidity, that's the big thing that's got his focus right now is how that's going to act as a liquidity sponge and start taking liquidity out of the system. So you have all these, these things that could pull us more into recession too, if left to fester or if triggered by some of this disruption that's going on. Yet a lot of this disruption that's going on could trigger inflation as well. So, it doesn't feel to me like we've got, a surgeon at the helm that is trying to chart a super precise course, right? It seems like we're bringing in somebody who's got a sledgehammer and a chainsaw, and again, a mandate to wield them. So it's going to be really interesting, and I can't tell you which way it's going to move. I just feel like the odds of disruption that catches all players by surprise is increasing and likely to be high going forward. One man's opinion, but I'm guessing maybe from what you've said, you sort of feel similarly here. So I guess my question is or not even a question, it's a comment. One, go back to your concluding thought there from your opening monologue of it's time to be cautious because of this higher risk. And I guess one question related to this, where I've said a variant of this before the election of whoever wins almost has an incentive for things to kind of like a lot of the froth to come out of the system really early on in their administration. And it's speculation. I believe it is true, but it's speculation. I think the current administration was doing everything it could to put as much lipstick on the pig and make everything look as good as it could to try to keep the economy looking as good as it could into the election. It didn't work. And now that the keys are going to Trump, I'm sure they're like, well, we're stopping everything that we did, right? And I think there's an incentive for Trump to like let that happen. And to your kind of a point you made earlier, like blame it all on he gets 2 years to blame it all on Joe Biden. And that might be the unifying force that as things get tough in the economy, Trump can say, yep, see, I warned you, but good thing I'm here. And, I've got all these programs and hang in there because we're getting there. Like that could be the rallying cry. I don't know. What do you think?
Yeah, first of all, Michael Howell, if you're watching this, Liquidity Sponge is a great name for a band. I think you should start a band called Liquidity
Agreed.
Sponge. But look, of course, Trump is going to do that because every president does that. Every president does that. In recessions that kind of happen, at the end of shorter cycles, when times have been pretty good for a while, you can kind of get away with it. When recessions happen, when times have been tough for Main Street America for as long as they have, and prices are so high and affordability is so low from so many things, from houses to groceries, it becomes much tougher to point and say it's his fault because people will say, okay, but you're the
Yeah.
president. Do something
Right.
about it.
I don't care. I need to feed my kids
Yeah,
tonight.
exactly
Yeah.
right. It's like, okay, fine, you're blaming Biden, but okay, so fix it. And it becomes a case of I'm looking at you to fix it now. It's not the blame is largely pointless at that point. So, you know, Trump will probably be hoping that things tank before he takes office, so he can come in, as you say, to your point, which I think is absolutely right, and say, "Hey, look how bad things are, but we're going to turn it around." Um, I feel, with no degree of certainty, because I'm never certain about anything, but I feel he is going to have to deal with a recession during his time in office. Um, and whilst there are people making a very strong and cogent case for no recession and a reacceleration and all these great things, which would be wonderful. Um, I think banking on that happening is dangerous, and I think making that your base case is even more dangerous. My strong feeling is that Trump will have to deal with a recession, and at that point, it becomes a question of how deep a recession is it. The traditional responses to it, cutting rates, adding liquidity, back to QE, all these things that we've seen before were all done without inflationary pressures
Hmm.
as a counterbalance to that. So I have
Until
no
COVID.
doubt until COVID. But I mean that recession was a very specific one, was firebombed with all kinds of stimulus and was averted because the crisis ultimately went away, and the stimulus worked. But the next recession is not, I suspect, going to be one where you lock everybody in their homes and send them
Right.
checks. That's not going to be the nature of it. Sorry,
Can,
you
can, can, can I just ask a question so you can
yeah,
address
please,
in the
please.
rest of your answer, which is, um, you think Trump's going to deal with a recession at some point in his administration. I know you're just making a probabilistic bet there, not necessarily a prediction, but and you're talking about the historic playbook of how the central planners would come and ride to the rescue. How how dangerous of a precedent did we set during COVID with direct payments to households? And do you expect that now that that genie is out of the bottle, the next time things get rough in the economy, even a garden variety recession, the consumers are going to say, well, give us the checks. You gave it to us last time. Give it to us now.
Yeah, I don't know how long it took Pavlov to train his dogs, but to salivate when that bell rang. But I promise you, human beings who get given free money, they don't need an awful lot of training. Once it's happened once, you expect when that bell rings, then the check's going to land. So that ship has sailed. People are going to absolutely expect checks. Um, and had the Democrats won the election, I feel pretty sure they would have got them, maybe preemptively in the form of student loan forgiveness, et cetera, the
Mm-hmm.
kind of programs that they campaigned on. Trump campaigned on a different platform, but the pressure is going to be his to deal with. People are going to be looking for handouts. And again, I think this is why, if I'm trying to imagine myself as Donald Trump, which is not something I try to spend an awful lot of time doing, um, as I think through, okay, this is the situation I'm in. These are the problems I'm likely to face. What is my clearest path through them? I keep coming back to the things I think are not easy wins for him, but easier wins for him. And I think he needs some wins early, because I think any president that gets some runs on the board early does buy themselves a bit of time
Mm-hmm.
if things go squirrely. So to me, I look at Russia, Ukraine, um, as perhaps an easier win for Trump. And unfortunately, the green light that Biden's given us last week, whatever the motivation for that was, we can all speculate if it was political or not. And you can make a good argument for it being overtly political, but let's put that aside. Um, no one's spoken to Putin. The Western leaders have had this policy that we're not even going to, we don't engage with terrorists. We're back to that again.
Mm-hmm.
And so simply by opening up a line of dialogue, you know, Trump has a chance. I saw a survey posted this week. For the first time, more than 50% of Ukrainians just want the war to end.
Right.
So you've got a willingness amongst Ukrainians to just get this thing over with. You've got a willingness from Europeans going into the winter with Russia's stranglehold on fuel supplies into Europe, and this kind of fatigue with all the money that's being sent into Ukraine when people across Europe are struggling with inflation and pressures of their own. You've got a similar feeling in America. So suddenly this idea of, oh my God, you're actually going to talk to Putin. You can spin that as, look, I'm going to end this war. And to do that, I need to speak to Putin. And so, I can picture, I've said this a few times recently, I can picture the scene at Camp David with Trump standing behind Zelensky and Putin shaking hands. Um, I can see Trump standing behind Netanyahu and whoever the 27th in line to the throne at Hamas is, and shaking hands and having a photo opportunity and putting these things behind him. Because there's a lot now, I think, of will on everybody's sides involved in these conflicts to try and come up with a face-saving solution. I think um, I think you would have to make some fairly significant concessions to Putin. Um, I do. And that will be a tough pill for everybody to swallow. But again, I think the window is there with the fatigue that everybody has to be able to spin that and to be able to, make it look like a quasi win for everybody. Um, and I think by trying to focus on those things and through back channels before January 20th, Trump engaging with Russia, engaging with Netanyahu, engaging with Iran, maybe even, although I think that's a bit of a bigger stretch, to try and tee up early peace talks once he gets in office. Because Biden's clearly shown that with the time he has left, escalation is seemingly the path he wants to take. Um, I think Trump has the potential to try and make it look like he's brokering a peace. Now, if he gets a peace in Russia and Ukraine, and he gets a peace in the Middle East, um, not only not only does it put him front and center for a Nobel Peace Prize, um, but more importantly, perhaps for Americans, it gives him something to point to if economic pain starts coming thick and fast for Americans. It does say, look, yeah, I know things are tough, but there's no more money going to Ukraine. We can use that money to bring home. We can use that money
Mhm.
to help Americans, blah, 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 blah. There are plenty of ways you can spin that. So if I was in his shoes, that would be what I would be looking to try and at least gauge the temperature. Is there something I can do here? Is there a deal to be done? Um, and the fact that Europe and the US have refused point blank to speak to Putin, I think is, I mean, we need diplomacy now. We need more than any time in the last 50, 60 years. We need diplomats to do what diplomats do, and that is have uncomfortable conversations with people you don't necessarily want to talk to. But there are bigger things at stake here than pride, and there are bigger things at stake here than face for mankind. This is the closest we've been to a nuclear conflict than at any point since the Cold War. And so we need some adults in the room who are willing to say, yeah, I get it. It doesn't look good, and we didn't want to do this, but for the greater good, these are things we've got to do. So that's how I handicap what I would do if I was in Trump's shoes between now and January, and then immediately after January 20th.
All right. Well, from your lips to the universe's ears on that one, hopefully these conflicts can be resolved sooner rather than later. There's all sorts of benefits that come from
Yeah.
that. All right. I want to switch gears if we can. I want to talk about your your market outlook. Um, there's your outlook for market returns from here, and there's some risks we've already discussed, right? So valuations are historically very rich at this point in time. There's how the stock market could react to the different types of disruptions that we've talked about, whether they're inflationary or disinflationary or even deflationary. Um, so, I talked about this sort of tug of war between instability and complacency, right, that we're seeing right now in the markets. There's also another element, and if I can, I want to just quote your words, if I can, on this, Grant. One of your peers, Matt Ziegler, quoted you recently, and I thought it was a really important point you were making. And so, folks, if you'll bear with me, this is a couple of paragraphs. I'll get through it as quickly as I can. And then I'd love for you to expound on this, Grant. Um, I kind of mourned the change in capital markets as a mean to allocate capital over the long term to productive use that will provide a steady long-term return on capital and will help grow a business. That's what it was all about when I got into it 40 years ago, and I don't recognize it anymore. I don't have any of the conversations I have today that I had 20 years ago, 30 years ago, 40 years ago. None. All people want to know about is the stock price. And that comes down also to CEOs of companies. The business is the stock price these days. And once you do that, once you change the business to be about the stock price, you change every incentive that has been developed over hundreds of years of capitalism about how to build a sustainable business, how to reinvest profits, and how to grow a business. So I think we've had some conversations on variations of this theme over the years, Grant, but I thought you just did a great job in that of just shining a really bright spotlight of saying, you know what, we've kind of bastardized or metastasized the capital markets here, not to be about price discovery, not to be about how are companies generating profits, intelligently reinvesting those profits to create more value for shareholders. It's really just about the nominal stock price and how that can be eternally juiced from here. And then everybody focuses around that as opposed to really creating sustainable value. So I just want to give you the floor on this because I think it's a very big point you made. I think it's a very important point you made. And if you can, in your answer, talk about, has that created a market environment now where we are more prone to, some sort of corrective event where, trees can't grow to the sky. You can't juice stock prices eternally higher than true valuations can support forever. What has that done to the system?
Yeah. This to me is perhaps the existential crisis facing investors, particularly in markets today. And my good friend Remy Tito and I are in the process of trying to do something about this with our principal investor project. This idea of fundamentals and value and all the things that are kind of out of fashion. To that quote, uh, I truly believe that. I truly believe that the nature of capital markets, the nature of investment, and the nature of what a business is designed to do have been fundamentally changed by the perversion of incentives, which naturally follows the perversion of money. Money is trust, and trust is the foundation of society. And I've talked about this for a couple of years now because I think this is so important for people to understand. Without trust, there can be no society, and without trust in money, there can be no value. And so, what's happened over the years has been this kind of debauchery of the value of money by the various means which we've talked about ad nauseum between QE and you know zero cost of capital and negative interest rate bonds and all the tools that have been employed to keep the game going and to avoid the pain that you talked about earlier on. What it's actually done is weaken trust in money, weaken trust in society, weaken trust in government, weaken trust in institutions. And if you incentivize CEOs through the stock price, which is what corporate America and corporate Europe and corporate Australia and Canada and all these other, actually corporate Europe is probably, let's set corporate Europe aside. America is actually a big outlier in this, in terms of the extent to which this has happened. Um, if you incentivize CEOs with massive option packages, their aim is to drive the stock price higher by any means necessary, and that has generally been through the a deterioration in quality of inputs and goods, through shrinkflation, through all of these ways that we can kind of find to juice profit margins and to keep growth going, and that growth has come at the expense of the consumer. Uh, and once that happens, and you reach this point of inaffordability, something has to give somewhere. And if you have undermined that trust in the dollar in your pocket, and therefore you undermine trust in your neighbor and in the government and all the other things in the business world, it's very difficult to get it back because when it breaks, when that trust, that loss of trust becomes evident and impossible to deny, everybody kind of does this. Everybody pulls things close. They pull in the reins. They go inwards. They don't go outwards. And there is nothing wrong with investing in a business that steadily returns the same kind of profit every year. There's nothing wrong with that. And reinvest those profits and pays dividends out. This is what used to be. And if it grows a little bit here and there, and it grows when times are good, and it holds itself together when times are bad, that's what it used to be all about, because it wasn't about the stock price. It was about investing in a productive business that would make a profit, pay a dividend, and reward investment over time. Um, if you have a business that stands still these days, but just consistently generates profits for its shareholders and pays a decent dividend, you get nowhere near the valuation that companies that promise to grow to the sky gets. And that will change. It will change. It will go back to the fundamentals, the principles of investing. It will go back there, and the journey from here to there is likely to be painful and littered with losses and littered with bankruptcies and littered with lost fortunes. But you cannot get away from these fundamental principles. You just can't. And the sooner people realize what those fundamental principles are and what value really means, not the promise of future value, but owning something of value, um, people will rediscover that. And so I think, when I was talking to Matt Ziegler about that, this is something that I feel very strongly, and I've talked about in one way or another for a couple of years, and I'm actively pursuing with Remy to try and ease people's transition back to understanding what this game is all about. And there are so many stories. I was in Switzerland a couple of weeks ago and was fortunate to spend a couple of days with my friend Tony Deaton, who
Mhm.
embodies these principles and these characteristics as well, if not better than anybody I know, certainly. And I'm sure there are others like him out there, but to me, he's a shining beacon of these kind of principles and these kind of fundamental values. And you know, Tony's told me a story in the past that I've recounted in one of my letters, but it's worth repeating here because it illustrates the point beautifully. And Tony talked about a guy, and I'll change the business and do all the stuff I did in my letter just for comparison's sake. But a guy who had a business, uh, it was a fantastic business. He ran it personally. It was, there was a line out the door. It was everything was the finest quality, the materials, the service, the staff, everything. And it was a small business in a small town. And every year, this guy would take his profits from the business and he would invest them in real estate. He would invest them in condos and ski chalets and stuff. That was just what he did, and he had a beautiful business and a great life, and he worked hard and he took great pride in this. And he had a never-ending stream every year of bankers who would come to his door and say, "Hey, you've got a phenomenal business here. We love what you're doing. We want to lend you a load of money. You could open 4 or 5 of these shops and build a franchise and grow this business and build something fantastic. And we'll give you the debt and we'll help you with all this stuff." And the guy every time would say, "Look, why would I do that? I've got to find, let's say I open 4 shops. I've got to find 4 people like me who have the
Mhm.
same work ethic, the same principles, the same values as I have. I've got to manage them. They've got to find 4 times the number of staff that I have. It brings me all these headaches. And, then it's about quality control. I've got all these headaches. Right now, I have a very simple life. I have a great business and I know exactly what I'm doing." And he turned them away every single year. And here we are 30 years later. He's an incredibly wealthy man who has a phenomenal business that's privately owned. It's not listed on the markets. And we should come on to why that's important in a second. And he has an enormous real estate portfolio, that provides him with an income. And any of the partners, maybe he went to friends to help finance the business originally, who bought into that business and have a share in that business, who participate in the returns from that business, not owners of the company's stock, not people who benefit when the stock price goes up, but they get a dividend stream from that business, have done phenomenally well also. And so the other component of this is how the stock market has become king. Everything is about the stock market. It's not about the businesses anymore. And when you list everything on a market, and there's a rush to list every single stock you can under the sun and ring the bell and be on CNBC ringing the bell, you lose the ability to run your business. As soon as you list, it's all about the stock price. And for investors out there, many of whom believe themselves to be investors, but they're really speculators, it's all about the stock price. It's not about the business. And stock prices can be manipulated, both by market operators and by companies, the way they, we're going to non-gap account this and we're going to squeeze this and we're going to write this off and we're going to, there are all kinds of things you can do to keep the illusion of growth going. But ultimately, gravity is fundamental and so is value. So, I think that that passage you quoted from my conversation with Matt is an important one. It's something that I spend a tremendous amount of time thinking about. And I think these are things that investors, and I want to make sure I differentiate between investors and speculators. If you are a speculator, great, have at it, but recognize what it is you're trying to achieve. It's just number go up. So recognize that that's what speculators do. If you're an investor, um, you need to unlearn lessons that have been drummed into you for decades now, depending on how long your investment career has been, and relearn lessons that stood the test of time for hundreds of years of capitalism. And if you do that, you give yourself a chance to be able to think differently, to be able to invest differently, and to be able to navigate your way through an increasingly uncertain future by returning to principles that over the long periods of time will stand the test of that time and will help you reduce volatility and grow your wealth, just not in the spangly, sparkly way that a lot of people have become accustomed to. Because this, what we're seeing right now, you know, meme coins going up 10,000% in a week and Nvidia and the Mag 7, this is the anomaly. These times are the anomaly. And the sooner you realize that, and the sooner you understand that you are living in the anomaly, and so you need to step out of it and understand what's happened before, because that's what we're going to go back to, I think the safer you're going to be in terms of accumulating and, more importantly, preserving long-term savings and wealth.
Okay.
Off my soapbox.
No.
Sorry.
Well, so that deafening sound you hear, Grant, is every viewer of this video standing up and giving you a standing ovation. I'm sure you're getting that from folks that have been watching here. I want to ask a devil's advocate question in just a second, but a few quick points along the way. One is, Grant, did you ever work for a corporation? Like, did you ever do the corporate life?
Well, I worked in investment banks for
Yeah,
30
yeah, okay, yeah. So, I mean, I
plus years.
started my career in Wall Street, and then, I spent many years in Silicon Valley. Most folks know I worked at Yahoo for about a decade. And I just remember back then the unnatural acts that were done approaching quarter close just to try to, polish things, to try to, again, bump the stock price,
Yep.
right? So to your point, when you set the incentive to stock price must go up, you depart from building value, right? You create all this stuff that's really fictitious, right? So to your point of like gravity is fundamental and so is value, you can only do that for so long. Now, we've been able to do it for a lot longer than most people, I think, could have imagined, myself especially. And again, my memories now are, a decade and a half old, right? The system's only become more hyper financialized since then, right? Personally, one of the reasons why I asked this question, and I think this sort of reflects the spirit of why you're raising this risk, is when I hear you talk, I think about this New Yorker cartoon. I don't know if you can read it here, Grant, but it's a
Yeah.
man in a tattered business suit speaking to children around the fire, saying, "Yeah, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for our shareholders," right? And I think this illustrates your point, which is right now that guy's suit is still fine. but it's because he's living in the anomaly, right? And when the anomaly ends, there is going to be a reckoning. There is going to be, some repricing that's going to need to basically bring prices more in line in valuations. And in most cases, that's downwards, right? For a lot of these companies, a lot of these meme coins, all this stuff, right? So I'm right there with you, and I agree with everything you said. But let me just play devil's advocate for a second, because I'm
Sure.
sure you hear the same question, which I get, right? So gravity is fundamental, and so is value, right? Some people might say, why? Why does it have to be that way, Grant? It's not, and it hasn't been for a long time. So when is it going to matter? And will it matter on a timeline that is relevant to me, right? Because, and you hear this a lot, I'm sure, being too early, same thing as being wrong, right? So why should I adopt a Tony Deaton-esque strategy here if it's not the right fit for the anomaly? Maybe the anomaly is going to last the rest of our lives. So just what is your response to somebody who comes at you with those questions?
Look, and I get them all the time, and they're perfectly valid questions to ask, and they're questions people should ask, Adam. Frankly, there are I get called a perma bear by people all the time, and
Hey,
there's plenty of
I'm
us in
right.
that camp.
I'm just so
Right,
you know, I'm right there with you, buddy. You got a lot
right,
of company.
right. But look, but to me, the issue is one of there are thousands, thousands and thousands of people who will tell you, buy this, it's going up, buy this, it's going up, everything's great, everything's going up. And that's fantastic. So if that's what you want to hear, you have no shortage of voices in your ear to tell you that stuff. I think of myself as perma-cautious, that's all, because I understand um, the importance of irreplaceable capital. I
Right,
understand how detrimental it is to just waste it away with that by short-termism and poor decision making. So when people talk about why are these things fundamental, um, you know, get a model of Sir Isaac Newton, sit him under a tree and drop an apple. It's going to land on his head again. Some things are fundamental, and whilst we can live in a period where value can be indeterminate and can mean different things to different people, which is absolutely fine. And I understand why people ascribe value to different things because, again, this comes down to personal responsibility. Value is what's valuable to you. To you, an NFT might be valuable, and that's perfectly fine. Um, Own that, decide what's valuable, and decide the meaning of that value to you. All I'm trying to say to people is don't assume that because an NFT is valuable, it's always going to be valuable. A company that is well run, services its customers, manages its debt, uh, finds a way to sell products that people need into a marketplace that need them and want them, will always be valuable. Will always be valuable. Gold, we can't say it will always be valuable. For 6,000 years, it's been valuable. It's held value to people. There is someone who will exchange you something for that gold. So the further, I think, I forget who said it, but the further backward we look, the further forward we can see. And I think that's a really important
Mhm.
concept right now for people to get in their heads, because if you do look back at the last 3 or 4 years, you will assume that an anonymous account on Twitter posting a meme picture can add a couple of $1 billion to the value of GameStop. And that is perfectly normal. If you look back 25 years, 30 years, you will realize how absurd that is. But it's difficult in the moment, particularly when people are making money. And that's why you have to keep coming back to this idea of the first thing everybody needs to do is understand who they are. I did a presentation about this last year called Who Are You? Are you an investor? Are you a speculator? And there's no right or wrong answer, and neither is better than the other. But if in the presentation, I had a slide that had a whole bunch of uh, news headlines when the Roaring Kitty thing that I was referring to came back and GME went up,
Mhm.
huge. And all the headlines on CNBC and Bloomberg and mainstream media, they all said retail investors flock to GME. Retail investors drive stock boom. Retail investors do this. None of them were investors. Not one of them was an investor. They were all speculators, and that's absolutely fine. But if you think of yourself as an investor and you are merely speculating on the price, then your methods and your outcomes are fundamentally misaligned. And you will make poor decisions around what you're trying to do. If you are a speculator, you are purely interested in the price of the stock going up. And what the business does doesn't matter to you, as it didn't matter to all the retail apes in AMC and retail apes in GME and all these meme stocks. The business didn't really matter. They would pay lip service to it, but what they talked about in the Reddits and the subreddits and on Twitter was the stock price, to the moon. They weren't talking about the business. They weren't talking about AMC
Right.
having 8 billion people in the theaters. They're talking about the stock price, and that's fine. But if you're focused purely on the stock price, then you are looking for a completely different set of signals to make your next move. If you're an investor in the company, you're looking for very different signals to make your next move. And so squaring that potential mismatch inside yourself, retail investor, retail speculator, and what does that mean, is absolutely the first thing everybody needs to do. What are your aims? Your platform's called Thoughtful Money. Everybody needs to be thoughtful about who they are, what they're trying to achieve, and the lengths to which they'll go to, and the methods to which they'll use to achieve that, and the risk management they'll put in place, and the risk tolerance they possess in pursuit of those aims. Once you have a proper understanding of all those things, it will make action much simpler for you. It will make decisions easier to make if you are understanding what your objectives are. And this comes back to businesses who will pay lip service to total addressable market and growing the business, but they're fundamentally in the business of raising the stock price. And so they will
Okay.
do things that are detrimental to the business, the long-term sustainability of the business, to beat the quarter and to get the stock price up and to hit the options vesting targets. And this misalignment that is everywhere now is a natural outcome of the corruption, and I use that in the literal sense, of money, of truth, of trust. This is where this was always going to go. And it's fine, but you have to recognize it and you have to understand your place in it.
Got it. And I would think you would say you also have to understand that the anomaly is not permanent. So you have to take in whichever path you choose, you have to take into your account the fact that
Yeah.
the playbook will
Well,
change.
Adam, I mean, look, it's a great point, and people can actually say, well, value isn't permanent because look for how many years no one's wanted to own value, right? So you can say that nothing's permanent. The point I'm trying to make is the cycles of value are longer and more reliable than the cycles of number go up.
Yeah.
Because there's always these infatuations. There's always something to be infatuated with that is giving you great returns and sucking in all that speculative capital. When the cycle turns, the speculations, as we saw in the internet boom, go back to their intrinsic value, which in many cases was zero.
Right.
If
Right.
you own a company, own a business that has intrinsic value, yes, the stock price might get hit in a general stock market route and it might trade below book value. But it will 99 times out of 100 trade back to book value and back to value once saner heads prevail, once the liquidity wash is done, once people have settled their margin calls and people have squared their own books again. That's really the point I'm trying to make here.
Yeah, and I agree 1,000% with it. I feel like in many ways, we are revisiting discussions that were had by John Mackey when he wrote, or McKee when he wrote the Madness of Crowds, right?
Mm-hmm. Yeah,
Um,
Charles Mackay. Yeah, yeah.
Charles Mackay,
Popular
yeah.
Delusions is if people are trying to Google it.
All right, so Grant, this has been fantastic. We're at a little over the hour, so I've got to start wrapping up here. Thank you so much for giving so much in this conversation. Real quick, I just made a note. I'm curious to get your answer at. When you talked about uh, I can't remember if you used the word fraud, but it was similar, saying that right now there's a lot of fraud-like activity, at least we'll say, that is done in the name of stock price go up. And I'm just curious,
Let's call it
would you
questionable. Let's call it questionable activity.
questionable,
How's that?
okay, questionable, or maybe my earlier word, unnatural. Um, would you put corporate stock buybacks under that umbrella?
Uh, that's a long question.
And I'll make
I
it
think
easy
it's
by
very.
saying
Put it this way.
unnet.
I think companies borrowing money because debt cheap to buy their stock back. I think that is questionable behavior, and there have been plenty of them that have done that. I think companies that have constantly bought stock back and then renewed the stock buyback program, you will find most of them are underwater. A few of them won't be, but most of them have ended up paying way too much for the stock they bought back.
Mhm.
There is a case to be made in a time when stock buybacks are absolutely in the best interest of the business. Normally, it's when the stock is trading below the fundamental
Right.
intrinsic value of the company. When you're buying stock back on a 50 PE, because you say we've got cash on the balance sheet and we think this is the best use of our
Right.
capital,
And you're
I
doing
have
that
I have a
every
problem with it.
quarter after quarter. Yeah,
Yeah,
exactly.
absolutely right. So not all stock backs are created equal, and like I said, if you're buying stock back for less than book value, it's it's definitely accretive to shareholders. If you're paying massive inflated valuations for it, I find that questionable. And if you're borrowing money, going into debt to do it, I find that even more so.
Okay. And I ask because, as you know, corporate stock buybacks have ballooned over the past couple decades.
Well,
And
as have insider sales this year, Adam, which is interesting. Insider sales are, there was an article in the FT the other day, at as high as they've been since, I forget how back the chart goes, but they are noticeably elevated now.
okay, so let's combine those two. Who benefits disproportionately from stock buybacks? Corporate insiders. When corporate insiders start getting out, that should be a real warning sign for you, right?
It should be. Yeah, it should be. And look, everything's very public these days. There are people, insiders selling globs of shares of companies that don't make headlines every day very quietly, and that's a lot of this the reason this chart is so high. But there are insiders of big companies. The Amazons or Jeff Bezos has sold a load of shares recently, and you'll notice every time they do, there's always an explanation for it. There's always it's part of a plan I put in place,
Sure.
or
Yeah.
I've got a tax bill, or whatever it is, whatever it is. Um, and you have to justify that. You have to find a way to justify it because you need to keep everybody in. If you said, "Hey, I'm selling my shares because I think this is the top," we all know what's going to happen.
Right, right.
So, incentives matter, and any insider who sells his shares has got a reason for you not to sell yours because they still own a whole bunch of them and they don't want the stock to go down. So just again, be aware of that. Be cognizant of it.
Great, great point. And again, another like watch what they do versus listen to what they say. All right. Well, look, Grant, two last concluding questions. The second of which is going to be I mentioned in the intro that you had just done a great conference. I think there's a replay of that, and I'd love to have you tell folks how to get that real quick, though, because they'll shoot me if I don't ask this. Um, I completely agree with your call to the investor to make it the decision. What are you in for? Are you in as an investor or as a speculator? Are there any other strategies or assets right now that you think are a particularly good fit for the moment in time we find ourselves now?
Yeah, again, I've talked about this. If you're coming to me for stock tickers, you're never going to get them because
Yep.
there's just no point in me giving you three-letter acronyms to buy because
Right.
I think they're good. I think the best thing I can do, and there are people who are way better qualified to me than give you those three-letter acronyms. But the best thing I can do is talk about things like building resiliency into your portfolio. And
Go for it.
you do that through owning things like precious metals. It's a boring answer, but it's one I've been consistent with for 20 odd years now. And the performance of precious metals, not just in price terms, but in purchasing power terms, more importantly, has borne them out as a valuable thing to have in your portfolio. Allocating capital, going back to that story about the business, allocating capital privately, and by that I don't mean buying an ETF that is full of stuff for private equity and private credit, but finding businesses to invest in, you don't have to put all your money in the stock market. You really don't have to do that. There are businesses you can invest in that will give you revenue streams and will not give you a daily mark to market that you have to lose sleep over every day.
Right. And maybe give
Lending.
you more ability to control too. You can't control a
Absolutely
share of
right.
Amazon, but yeah.
Absolutely right. Yeah, yeah. Private credit, and again, not private credit, capital P, capital C,
Yeah.
but private credit in terms of lending money to businesses who are looking for a small financing round and can give you a decent return with very little risk. They're not rated. They're not rated by agencies because it's a local business that needs to borrow, 100 grand for something and will pay you, because they need to, they'll pay you 10% on it.
Right. A
And
bridge
the
loan. Yeah.
business and the owners and allocating your capital to things that you understand and that give you as high a possibility of a return on that capital as possible is again a return to fundamental investing. And it doesn't have to be, nor should it be exclusively the stock market or you know one of the X amount of thousand companies that you can buy with the click of an app. Uh, Find places to go that aren't crowded. Do the extra work required to invest your capital in places that are out of the way, because if they're out of the way, if the walls come tumbling down, they're out of the way and they won't get swept up in any kind of general market pullback. Again, it comes back to the fundamentals of what does it mean to be an investor? And to be an investor means exactly that, to allocate your capital to a business that over the long term is going to provide you with steady, predictable returns with the possibility of growth, but it's not going to go to zero. Or at least you've got a
Mhm.
very high level of confidence that it's not going to go to zero. And, we see this all the time in markets. We see people trying to explain why a company fell, your target fell 20% today. Is that a fair representation of what's happened to its business? Probably not. Is it a fair representation of how carried away the stock price had gotten? Probably so. So think about those two and the juxtaposition between the two and allocate your capital accordingly.
All right, great answer. If I had more time, Grant, I'd want to really peel your brain on the specifics of what came out from the recent conference that you did. We don't have time here, but the good news for viewers is they can watch the whole thing if they want to, right? So just give a quick summary of the conference, who are some of the key top speakers were, and where should folks go if they want to look into buying the replay from it?
Sure, absolutely. Yeah, we did a 1 day conference. It was the brainchild of Dave Iban of Copernic Investors. One of the great value investors of his generation, and he, for reasons best known to himself, asked me and our mutual friend, the great Stephanie Pombai, to kind of host the conference for him, which we did in Tampa last week. We had a phenomenal turnout, both in the audience and the speakers. We had Felix Zulauf, we had Cy Jacobs, we had a terrific debate, and this raised a lot of eyebrows between Kathy Wood and Dave Iban about what constitutes value. And there was so much in there for people who are willing to sit back and listen to an old school value investor and someone who has redefined value. Whichever side of that coin you're on, I promise you there's so many takeaways from that conversation. It was fantastic. We had Peter Atwater there. Steph managed to drag Bob Rodriguez out of his seclusion. And for people that don't know Bob, Bob is an absolute legend of the industry that retired a while ago, but is still very actively involved and just a great thinker. And then we had my dear friend Sir Stephen Wilkinson join us, which was another mind-boggling conversation as Sir Stephen thinks about things in a very different way. And some of the topics we discussed um, were immensely thought-provoking for the audience. So that's a bit longer than I probably planned to go on. But if people want to look at the virtual pass, which is a recording of all the conversations, if you go to grant-williams.com/super terrific happy day virtual pass with a dash between every one of those words, you can find out. It's grant-williams.com/super terrific happy day virtual pass with a dash between every one of those words, and everything's up there, and the videos will be available. They're being edited now. They'll be available in the next couple of days.
All right, fantastic. Grant, when I edit this, if there's enough room on the screen, I'll display that URL for folks. But whether there is or isn't, folks, we'll have the link in the description below this video too, so you can get there. with one click. I heard from folks that attended, Grant, that it was a phenomenal experience. And for folks that would like to follow you and your work, besides going and buying the replay, where should they go just to follow you and your general work that you put out?
Easy. Knock off the super terrific happy day virtual pass, all the dashes, just grant-williams.com. And I'm on Twitter at TTMYGH, which is just the acronym for things that make you go,
All right. Grant, bear with me for 30 seconds. I've got a little bit of housekeeping, and then I want to give you the last word here. Folks, if you've enjoyed having Grant on and really appreciate just how open he's been with all of his expertise and insights, please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And once you've decided, where you fall, investor versus speculator, I'm going to make the easy bet here and think most of you watching here identify as investors and are looking to navigate this future that could be quite disruptive, as Grant and I talked about in the first half of this conversation. If you'd like some help on how to navigate that, with your portfolio allocation, highly recommend that you do that under the guidance of a good professional financial advisor who understands the macro issues that Grant and I have talked about here. And when you put those three requirements together, professional, good, and understand this macro set of topics, then the universe actually gets pretty narrow. But if you've got a good one who meets them, who's doing a good job for you, obviously stick with them. But if you don't, even if you just like a second opinion from one that meets those criteria, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To schedule one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. They're free, as I've said. There's no commitment to work with these guys. It's just a free public service that they offer. All right, and when you're there at Thoughtful Money too, don't forget to click the newsletter link at the top of the site menu there, and that's how you can sign up for our free Substack newsletter. All right, Grant, thanks for your patience there, my friend. I'd like to give you just the opportunity to give any parting last words of counsel to today's investors watching this video who are just trying to navigate what's ahead, most hopefully not become collateral damage to this disruption, but hopefully are able to prudently grow their wealth going forward.
I'll keep it short because I think I've pontificated enough, and I apologize for that. But I think the simplest way for me to sum this up is the future is not going to look like the recent past. And so it's probably going to look more like a more distant past. So the more you understand what the more distant past looked like, the less chance there is of you not realizing that things doubling and tripling in a day, zero interest rates, negative interest rate bearing bonds. This is the anomaly, and I think it's important for people to find a way to understand that and get a better handle on what financial normalcy and normal financial conditions look like.
All right, fantastic. Grant, I can't thank you enough. This has been absolutely wonderful. Thank you, my friend.
Great pleasure, my friend. Anytime.
All right, everybody else, thanks so much for watching.